So now let's zoom out. What model is doing good job, right? It's not good. Model is not good predicting what's going to happen on February 16 or March 3rd, but it's good giving you the trends. So for the 6 months neutral trend, models say next. And how does it make this determination? The daily, the daily 10-day prediction, the input into the model, which is important to understand, is 1 day. Every time you are using models or using services, try to understand how do these models work. Because I understand that even for me, this is just kind of some voodoo magic or some kind of cloud, right? What is the cloud? Nobody knows. It's just some kind of AI cloud, which is fine. You don't need to understand how the model works, what the internals of the market works, but you have to understand what are the inputs to the model and what are the outputs. Because if you don't understand how the trader makes decisions in terms of input and output, then you will make wrong interpretation of the model. So Stock Forecast Toolbox doesn't look at any fundamental data, doesn't look at any historical heuristic data. It only looks at prices: open, close, low, and high, and each data point updated daily. So that means we do not rely on incomplete data, right? If the market moved 10%, if Facebook dropped 20% intraday, model doesn't see it. It doesn't know. That input doesn't go into the model. Only end of day prices go into the model. So the 10-day forecast updated daily. The 6 months forecast is updated monthly. So it doesn't care if Facebook is up 20% and Amazon, Facebook is down 20% and Amazon is up 10%. All of this is noise within the months. Once the month is completed, then the model will say, okay, based on the long-term trends, we expect stock market to be between 438 and 487. So as a tactical trader, you basically say at 438, I want to buy. If market reaches at 487, I want to sell, right? And the trend as of right now is still bullish. Very valuable information for a trader, right? What does it tell me? Well, if the market is going to reach, if the spiders is already at 444, right, we're turning negative. At 438, I want to get, bullish, right? I want to. My fear of missing out should start kicking in when we're getting to 438. If we reach 460, 470, my fear of future regret should kick it in, right? So at 438, right? At 438, this is where you should get fear of missing out, right? Unfortunately, you get a different feeling, right? You have fear that the market is going to collapse, but model doesn't care about ECB decision, doesn't care about anything. It tells you historically, based on the current trend, unless there is some kind of a black swan event, but looking at all of the data that we have collected in the past years, 438 is a good entry point for the market. Does it mean it cannot drop to 430? Does it mean it cannot drop to 420? No, it doesn't mean that. But it means that the market at 438 is oversold. 1 sigma move, 2 sigma move. So if it's 138, this is, let's say, call it 1 sigma move. Well, all it means that 420 is a 2 sigma move. So it's another conditioning, right? We've always been conditioning that the prices revert to its mean. And if you look at the bell-shaped distribution curve, that the prices stay at 1 sigma, right? That's how majority of the people think. And even more people, right? This is 76%. Even more people think that 2 sigma, only 99% of the time, it goes. But we've seen that when you have ECB decisions, right? And when interest rates jump, 10-year yield jumps to almost 2%, this is a 2 sigma move. This is probably 3 sigma move. Very rare, very unlikely event, but you have to at least understand that doesn't mean you cannot go from 1 sigma to 2 sigma. Why do you care about this? Is it just a bunch of technical jargon? No, the reason I'm mentioning this, again, you want to hope for the best, right? When market reaches 438, it's oversold, right? You're hoping for the best and you're buying, but you're assuming that it can move 2 sigma, right? Or 3 sigma, excuse me. And if it reaches this level, the only reason I'm mentioning all this, you do not want to be down more than at 20%, right? That would be a mistake. Why would there be this mistake? Because just because market moved 1 sigma, it doesn't mean it's not going to move 2 sigma. It doesn't mean it's not going to be. The sigmas will be determined by the news in the market, right? If you know, we had ECB decision, there were dovish, right? In December, they came out and say, you know, inflation is transitory, no problems. Our wages are still low, unemployment low. We're not going to raise interest rates. We're going to keep them negative. Great. You know, yesterday they came out, same kind of story, but they say, you know what? It looks like it's not transitory. And all of a sudden, you have 2 sigma move, even though everybody kind of already anticipated it, that ECB will follow the Fed, right? The Europe has to follow the United States. But nobody knows, will that announcement be in January, February, or March? That no one knew. So you have these 2 sigma and 3 sigma moves when the actual event comes out, and now people realize, well, you know what, you know, Europe have the same inflationary pressures than the United States. So that's a very important mindset. So I think you have to have the mindset of a trader, and you have to, and if you haven't traded long enough, never, first of all, never blame, you know, always take your own responsibility. And the second one, well, more importantly, it doesn't matter what anybody tells you, you do not want to be down. You know, yesterday we had few subscribers that says, I was listening on the news, you know, Kevin O'Leary said, buy Facebook. I bought Facebook, and I lost 10% of my portfolio. Vlad, how does this happen? My answer is, you know, it's not Kevin O'Leary has nothing to do with your losses, right? You can blame it on Kevin O'Leary, and you might not have to listen to Kevin O'Leary ever again, but he's a great guy. He's smart. He's dedicated. He means well. It is your issue. You decided to risk more than 10% of your portfolio on the news, on somebody who's managing other people's money, right? That's nobody's fault. The only body's fault is, you know, you got to be responsible for that. So my point is that when you're down more than 2.5%, you cannot. That is your own mistake, right? That is a mistake. When I'm down more than 2.5% position, I don't blame it on Stock Forecast Toolbox, or I don't blame it on news or research. I understand I made a mistake. I got overly aggressive. In the future, I'm going to size my position accordingly to make sure that I don't repeat the same mistake. Doesn't matter if Facebook dropped 20%, 30%, or 99%. Your portfolio should never be down more than 2.5%, right? And if it is, then that's the lesson. Your size of your position is, you assume that Facebook cannot drop 20%. But that's a wrong assumption, right? Just because it didn't drop, it never dropped more than 20%, doesn't mean it's not going to do it now, right? Snap rallied 30% or 50%. It never rallied 50%, but now it did, right? And if you were shorting Snap, then, you know, if you lost less than 2.5%, then that it happens, right? You can blame it on Kevin O'Leary. But if it's more than 2.5%, then that's, you know, just something you have done incorrectly.